Hello, everybody. Welcome, and thank you for taking some time to be with us today. My name is Andrew Cady. I am sitting in for Todd Bitter. Todd, unfortunately, could not make it today, but this is definitely like right up my alleyway of things that I love to look at and do every single day of my life. And so I'm going to set my screen up here real quick, and I'm ready to roll into this. So what I want to dive into today, we're going to talk about the real estate forecast. We're going to talk about what 2024 brings to the housing market. You say, who are you to look at it? Well, let's dive into a little bit about me. My my name's Andrew Cady. I run the Epic Mortgage team here over at UMortgage. Um, as a team, we've closed just over $900 million worth of business just in the last 9 years. We'll be closing in on that $1 billion mark probably about mid-year this year. I was named top 40 under 40 in 2019 by National Mortgage Professional Magazine. And for 4 years in a row, I made top 1% loan originators in the country. Outside of that, I've been a student for about 7 years now of housing economics and housing market data, diving really deep into where we're going on a daily basis in the housing market. One of my mentors and an amazing person, I have to give a lot of the credit for the information on a lot of these slides to Barry Habib over at MBS Highway. Barry has more knowledge on the housing market than arguably anybody out there. Barry has won the Pulsonomics and Zillow Crystal Ball Award 3 times for housing market predictions. No one's even come close to doing that. And I'm blessed to call him a friend and happy that we get to dive into some of the slides here. So let's jump right into it today, and let's begin talking about mortgage rate predictions for 2024. What we're looking at on these predictions here is from Redfin Economics and from Freddie Mac, their primary mortgage survey. So Freddie Mac, if you don't know, they're one of the big mortgaged GSEs. So basically, conventional loans are guaranteed by either Fannie Mae or Freddie Mac. And so Freddie Mac is one of those, and they put out mortgage predictions every single year. What we're looking at on these predictions between Redfin and Freddie Mac is in quarter 1, we're looking at somewhere around 7% for a median fixed 30-year mortgage rate. Right now, we're at about 7.15% on a fixed 30-year average. If you look at Mortgage Daily News, that's where they're putting the average given out mortgage interest rate on a fixed 30-year at. We still have another month to go in quarter 1, and based on the economics, I could see us definitely ending quarter 1 somewhere right around that 7% mark. We still have another Fed meeting to come out at the end of March. We don't expect them to cut interest rates, but the market also doesn't expect them to cut interest rates. So I do believe we're going to see these numbers kind of hold true as to what we're looking for heading in to the end of quarter 1. Quarter 2, based on these two, don't predict much of a change. We're going to probably see interest rates remain a little bit stickier than we had hoped at the beginning of this year. And this is because the Fed has decided that they are really going to hold their guns on this higher for longer premise they've set. What do I mean by higher for longer? Higher for longer meaning the Fed has raised the federal funds rate, which is different than mortgage rates, but impacts them. So the Fed has raised the federal funds rate to combat inflation. Well, they believe they need to hold that interest rate higher for a longer period of time to really make sure inflation is in line. I personally disagree with this. I think mortgage, if you look at the federal funds rate and where the consumer price index shows inflation to be right now, I think we're actually really close to being at the Fed's target number, and they may overshoot this a little bit, and we'll talk about that scary word recession of what that could look like, because if they overshoot and they keep the federal funds rate too high for too long, it's going to crack the employment market, and we're going to see a recession come out of it. Now, you go to quarter 3, they're expecting a little bit further drop in mortgage rates down to a 6.7%, and the end of the year, quarter 4, around 6.6%. Now, this is a really interesting number because there's other metrics out there besides Redfin and Freddie Mac. We chose these two, but if you look at the Mortgage Bankers Association, MBA, they also do a mortgage forecast, and they're showing interest rates by the end of the year closer to 6.1%. And I'm wondering if the economics majors over at the MBA have maybe a little bit more foresight into some economic struggles we're going to walk into because of what the Fed is doing, that they actually, in my opinion, might be a little bit more accurate. I think we could see interest rates take a dive a little bit sooner than we were thinking. Now, let's talk about this recession word, because recessions, to me, it's one of those big scary things that we don't like to talk about. It's the big scary R word. But in the world of housing, recessions are not necessarily all that problematic. And we see this end of 2024 number at 6.6% for the interest rate here. Well, that number could be dramatically lower if we see ourselves in a period of a recession. And so what we want to look at here is what happens to housing, what happens to mortgage rates during times of recession. If you look at this chart, the vertical bars on this chart here, those are periods of recession in the country. Now we go all the way back here, we start looking at 1975, the one just after 1980, the early 80s, early 90s, 2000s, 2008, we know that big one, and then in 2020. There's a constant pattern of what happens when we enter a period of recession in this country is mortgage rates take a big drop, and they don't just drop during the period of recession. They drop about halfway through the recession and then drop typically for an extended amount of time after the recession. And that's a really, really good thing that we could see come out of a recessionary period for the housing market. And you say, well, look at the 1975, that vertical bar there for the recessionary period. Interest rates were rising into the recession. And yes, that is true. And that is because the technical definition of a recession, you don't know you're in a recession until you're about 6 months into one. Because the technical definition, it's when the gross domestic product or GDP of the United States is in decline, it's decreasing, it's shrinking below zero for 2 quarters in a row. So people who are calling out a recession today may be right, but we won't know about it until the economy shows it 6 months later. So you see this once the official recession is called, mortgage rates in every single period begin a decline. So there is that probability that we could see mortgage rates end up significantly lower than where we were originally forecasting, or where these experts are forecasting at 6.6 or 6.1% by the end of the year. Here's why that is a really, really big deal. Because every 1% drop in interest rates, it introduces another 5 million buyers into the housing market. And you say, where are those 5 million buyers coming from? Well, those are buyers that are out there. Those are buyers that are standing by, that are interested in housing. But over the last couple of years, or really 18 months, there's been a lot of buyers that have been moved to the sidelines from home shopping. They're not out of the game. Imagine a football game. They're on the sidelines. They've got an injury. Their injury is they're priced out of the market right now. But that doesn't mean they're out of the game. Once that injury subsides and the rates come back down where affordability is available for them again, they're going to re-enter the market. And that is going to be where we're going to see the housing market begin to really expand on us again. And this is where we're going to find ourselves in really a supply and demand setup. And this is something I want to dive pretty deep into. Right now, competition is pretty low in the housing market. Yes, in some markets, we're seeing a lot of multiple offers, housing market's booming, but we have to look at this as a whole nationwide. This is a nationwide setup here. We've got people from all over the country on this webinar right now. We have to look at this as a whole. We're not talking about maybe a select market like Miami-Dade County where it's booming, but we're talking about just in general. Competition overall is pretty low. We're seeing it on the mortgage side on a daily basis. We're seeing offers accepted at or below the listing price, and seller concessions being added to a lot of offers. That tells me there's not a lot of competition, because if you had 30 offers on a property, well, there's not going to be any seller concessions involved, and you're probably going to go up and above that asking price, going to highest and best situation. However, as we get more competition into the market, we're going to see home prices rise in 2024. Why is this? Well, this is coming down to supply and demand. And I'm going to dive deeper on the next slide into this, why this is different than 2008. As a mortgage originator, this is something we hear all the time. We're waiting for home prices to crash before we buy. This is the next 2008. You know, we think home values are about to drop. And I couldn't disagree with that statement any more than it's just crazy. And here's why. Right now, we're dealing with a undersupply of housing, and we don't have a ton of buyers on the scene, but they're just on the sidelines. Interest rates have slowed the demand. However, if interest rates begin to drop, we are immediately going to see home prices become higher and higher and higher because there's not enough inventory to currently handle the demand that's out there. Let's look at inventory and specifically what happened in 2000, post 2008, after we went through the mortgage meltdown of 2008. And I want to dive really deep into this chart because this is, I've personally used this chart dozens of times in presentations, both locally and nationally and on national stages. And I think it's one of the most underrated charts. This information is from the Federal Reserve Economic Data, FRED. Now, if you're a data nerd like myself, you're a data junkie, you love it, hop on FRED. Go just Google search Federal Reserve Economic Data, and they have charts for almost everything. And it's amazing data you can find in there. What I want to do is I want to look at this chart, and I want to go all the way back here into the 1950s. This red line across the center of the chart, this is that 1.56 million homes being built in America. And it's a very, very important number. Here's why. In order for us to sustain new household formations is when someone moves out of the house and they buy their first home, not necessarily happening together. They may move out at 28, but buying their first home, it typically is at 33 years old is the median age that a new household formation comes together. And what we see is we need 1.46 million homes built in America, new construction to be built, for us to reach a level of just sustaining household formations. Now, why is it at 1.56 instead of 1.46? Because each year we need about 100,000 additional homes built in America to recoup either homes that have aged out of the market and are being torn down because they've aged out, natural disasters, hurricanes, floods, earthquakes, destroy homes, fires, things that happen. We need about another 100,000 homes built just to sustain the current market. And what's really a crazy and interesting statistic is you go all the way back here to the 1950s. At the beginning of this chart, we were building 1.56 million homes. And you see, as we go down this chart, we have periods of underbuilding and periods of overbuilding, and it ebbs and flows. And there's never really a big overbuilding without a bigger underbuilding. You see here in, what is that, the 1970s, early 1970s, we had a big spike of building, but then it dropped off with a nice big spike. And we've always had this ebb and flow. But what you can see happened leading up to the 2000 crash, we had a decade of overbuilding in America. We had a solid decade, really, call it from 1996 to 2006, we built too many homes for household formations in America. And you see this leading up to the big crash of 2008. And what happened was we had the exact opposite situation from what we have today. In 2008, we had way too many homes and way too few buyers. And the buyers that we did have, the pool got shrunk extremely small because there was such a large recession and so many people lost their jobs. So the buyer pool is even contracted further. So we had way too many homes that have been built over the course of a decade. And then we saw the crash. What we're dealing with now is we've gone through a full decade, really like 14 years of underbuilding. That is the yellow highlighted section in here. Following the crash of 2008, we hit the lowest point of new home construction that we've ever seen in the history of America. And this is new housing starts. These are building permits being pulled. And really, if you look at the data on it, really from 2009 until 2021, a 12-year window, we did not hit that 1.56 million homes being built. And even when in 2021, when we hit it, we broke above it for a few months. And even today, we're currently underbuilding for just basic supply and demand. That's why I say when interest rates come down, you're going to have a flood of buyers come back into the market. And you look at the data, Moody's recently put out a study that says we're still around 2 million homes short in America for what needs to for the supply or the demand that's currently pent up and out there. 2 million homes. So imagine that if we overbuilt 1.76 million homes per year, every year, and did that for a decade, that's what it would take to just satisfy the current shortage we have. So the shortage of inventory isn't going anywhere. It's not going anywhere anytime soon. If we see a recessionary period, yes, there'll be people that can't afford their homes. But the vast majority of Americans have a lot of equity in their home and will have the ability to sell their home and not foreclose. Sure, there will be select scenarios where people have very little money down. Perhaps it was a bond program loan they did and they have very little or no money down on a loan that they bought at the peak in 2022. And if they lost their job in 2023, sure, we will see, if we see a recessionary period, there will be an uptick in foreclosures, but it won't be anything like what we saw leading up into 2008, 2009. We're just simply in a different market. So what are we predicting now for home price forecasts? Because that's really what we have to look at. So let's look at home price forecast. This is from the National Association of Realtors and Keeping Current Matters. And we want to look at the gray bars on the very left there. This is the average of everyone put together. We're showing an average of a 1.5% increase in home prices in 2024. And I would venture to say that 1.5% increase in 2024 would be that we don't experience a recessionary period. If we would experience a recessionary period, we would see mortgage rates drop significantly. Buyers would flood the market. We have this compounding factor right now that there's a large percentage, nearly 40% of all mortgages that are currently out in America right now have an interest rate of below 3.5%. That's a lot of mortgages. And a lot of sellers are not motivated to sell that home if interest rates are high. So it's going to take some time for those sellers to want to come to the market. So the inventory issue is actually going to be compounded by that factor. So we're going to see home prices continue to rise going into 2024. We're not going to see this decrease. Sure, there may be select markets. Again, this is national averages. There may be select markets that are overinflated right now that we do see a decrease in home values. That's a real possibility. But is it going to be a mass across the country? The data just simply doesn't show that that is going to be even remotely the case. If you look at Fannie Mae, they're saying a 2.8% increase in home prices this year. The Mortgage Bankers Association, 1.1. National Association of Realtors, they're the most conservative at 0.7%. I'd venture to say those numbers could easily double if we see a recessionary period. So we're in a strong housing market, and that's a really, really good thing. Overall, 2024 is a way better time to buy than it was in 2023, especially right now. If you're a real estate agent and you're watching this, please communicate with your buyers and understand that right now is an opportunity. If we have millions of additional buyers re-enter the market, the home that is listed today at $500,000, that your buyer could go in and place a $495 offer on and get maybe $5,000 or $7,000 of seller concessions. If interest rates dropped 1.5% tomorrow, that home would not sell for $500,000. It would sell for over asking price because there will be an influx of buyers to the market, ready to buy, coming back into the market. Seller concessions are off the table. The home they're buying can be a forever home. The mortgage they get doesn't have to be a forever mortgage. I'm not going to sit here and say, buy today, you guys can refinance in 6 months. We don't know that. We don't know, and I frankly don't trust our Federal Reserve and Jerome Powell enough to give you a date and say you can refinance in this time. But what I can say is, if rates drop, you can always refinance your mortgage. You can't always get the home you can get today for the same price you could get it today. And I'm going to show you a chart in a couple minutes here that is really, really eye-opening specifically to that. So let's talk about, oh, I missed the slide there, sorry. Let's talk about home sales rising in 2024. This is the expectations, is that if you take the average of all, this is the National Association of Realtors again, Keeping Current Matters, and this is from Fannie Mae, the Mortgage Bankers Association, and NAR. The average of all shows that we're going to have about 400,000 additional home sales in America this year. That's a great number. Now, if you're a real estate agent, which on this call, we're real estate agents, It's really amazing because there was a significant drop off in the number of real estate agents over the past 18 months. So if we're selling 400,000 additional homes and there's less competition, if you're out there in your market and you're working hard and you're grinding it, you have a bigger piece of the pie that you have the ability to get this year. So even though we're not looking at 2020 or 2021 gangbuster numbers, you should be able to simply increase your lion's share of the business just because there's less competition and there's going to be more business done. That's an amazing thing. Breaking these down, Fannie Mae, they're predicting it to be somewhat of a flat year at 4.8 million homes. Mortgage Bankers Association, a little bit better. They're showing there will be about 300,000 additional homes sold. National Association of Realtors, they're out there saying 700,000 additional homes sold. And again, National Association of Realtors, I like where their economics come from on this. And I would venture to say that's probably closer to going to be where it's going to be at than any of the other statistics, because they typically are going to have the pulse on this better than Fannie Mae and the Mortgage Bankers Association. So let's look at this next chart, because this is arguably my favorite chart of all times. And screenshot this if you want, and I'll pause here real quick and say, if you have questions, drop them in the questions panel. I've got a little screen up right here that I can look and see your questions as they come in. I would love to answer questions. We're going to have a Q&A at the end. If we have questions, I may hold some till then, but if you have questions on a particular slide, drop it in. I would love to answer your questions. So this next slide is arguably one of my favorites. Screenshot it. If your screenshot isn't good, reach out to us. We can get you a copy of this slide. It's amazing. This is directly from Barry Habib over at MBS Highway. And what we're looking at here, I'll explain this slide a little bit, is if you bought a home in, let's say, any one of these years, this is about a 75-year look at home prices. And we're saying you bought the home for $100,000. What would the price be, the value of that home be just 10 years later? And if you look at, say, 1942, if you bought a $100,000 home in 1942 and you held it until 1952, that home would have appreciated 153% and would be worth $252,000. And you can pick any one of these date ranges. Pick 1982, 57% increase on your money in 10 years. There's only one time out of the last 70 plus years that if you bought a home for $100,000, it would have been worth less 10 years later. And that was at the peak of the housing market right before the crash in 2006. And again, if you held that house for 10 years, you would have only lost 3% on the value of that house. If you would have held it for 11 years, you'd have made your money back. But this is just a 10-year look. And this is why we need to talk to our buyers on a daily basis. It's the same thing with investing in the market. There's a difference between trying to time the market and spending time in the market. Warren Buffett, he's famous for saying that. He never tries to time a buy or a sell in the market. It's all about the amount of time you spend in it. Real estate historically is proven to be one of the absolute best investments that your clients, yourselves, myself can make. I personally have had almost 100% increase, over 100% increase in the value of my home. And I'm one of those people that has the 2.6% interest rate. So I'm going to be one of those sellers that has the golden handcuffs. It's going to be hard for me to want to sell that home unless I'm downsizing as my kids move out of the house. But there's nowhere else I could have gone and put money down. And I think about it this way, my home value has increased by 100%. Now, let's look at this. Like you say, well, you know, if I bought a home in, let's pick a year, let's pick 2010, and I held it for 10 years, I got 45%. That's only 4.5% return on my money and, you know, over a course of 10 years. And that's the wrong way to think about it, because that's assuming you bought that house for cash. Chances are you only put 10% down on that house. 10% down of a $100,000 home, your $10,000 investment has made you $44,000. So it's a massive return on investment. And so we have to look at this and be able to explain this to our clients, that the best time to buy a home was always 4 or 5 years ago. The next best time is today. The next best time after that is tomorrow. It's time spent in the market. I'm about wrapped up here. In summary, 2024, is going to be a way better year than 2023. We are already seeing it here, on a small kind of micro scale. Our team here in Florida, we operate in South Florida, Central Florida, the Panhandle, and in Northeast Florida. We're seeing on a daily basis in February activities that took us a week to hit those same activities just in third quarter of last year. And this is February. Traditionally, January and February are not the busiest months. In fact, they're some of the slowest months of the year that we deal with in the mortgage industry. However, this February, we've already beat our all-time record for number of pre-approved buyers in a month, and we're closing our biggest closing month we've ever had in February of this year. So we're already seeing the market rebound in a really, really amazing way. So let's turn and get some questions up. If anybody has questions, please drop them in the questions panel. I'll give it about 5 minutes here, and I'll just kind of continue to jabber if I don't have any questions come in. But I will say I appreciate everybody joining today. There's a lot of people on this call, which is awesome because it shows your dedication to your craft. It shows your dedication that this isn't a hobby for you. Those who succeed in this business, whether you're on the real estate side or the mortgage side, it takes considering this a craft, wanting to get better every day. That's one of the core values we have here at UMortgage, is getting better every single day. If all I can do is just get 1% better every single day, I've improved 365% in just the course of a year. So kudos to you for being here. Drop some questions in if you got some questions. I would love for any questions across the broad scheme of the market. We're definitely in a crazy market right now, and I'll dive backwards a little bit and talk about the Federal Reserve. The reason mortgage rates have come back up, we saw this at the beginning or at the end of last year, beginning of third quarter, we saw interest rates at 8%, and then we saw them drop off and we saw them come down. And the reason they came down into the low sixes was there was a heavy anticipation that the Federal Reserve would begin cutting rates in March of this year. And the reason we've seen interest rates begin to climb back up once again is because the Federal Reserve is now walking that back, and they're saying they're not confident that they have done enough to bring inflation in line. However, the inflation target the Federal Reserve is trying to hit is a 2% inflation. And if you look at a 8-month average of inflation, it's at 2.1%. And so for me, it's why I say I think the Fed is overdoing it a little bit. And now the market is pricing in that the Fed will not be doing a rate cut in March, and they will also not be doing a rate cut at their May meeting. But that is all going to be data dependent. And when I say data dependent, what do I mean by that? Right now, the markets are saying we don't believe the Fed is going to do it. However, should we start to show cracks in the economy, let's say the unemployment rate rises by 0.3% at the next reading, that is going to pressure the Fed to begin to make moves ahead of their normal schedule. So we have to watch the Fed. And this is why there's no one that truly has the crystal ball that says, oh, we're going to be here on this date. It's why if you're working with a loan originator and they telling buyers, it's one of my biggest frustrations, oh, buy today, you can refinance in 6 months. That's highly, highly misleading. And it's wrong to do that because we don't know. If the economy shows its continued strength, the Fed is going to hold higher for longer, and we're going to be in this ride for a little bit longer. If the economy begins to show cracks sooner rather than later, it's going to force the Fed's hand to cut interest rates. When they cut interest rates, we're going to find ourselves in a much better spot. But overall, 2024 is going to be an amazing year. We're already seeing it here. We're putting up record months, and this isn't because we're getting that much bigger. It's just the activity level is coming up. I've had one loan originator, Courtney Douglas, shout out to Courtney on my team. He's run over 20 credit reports just this month, which is 20 buyers applying for financing with just one loan officer in a month. It's amazing to see what we're seeing. One question that's popped in, probably the only question, is from Alma. Can we get the slideshows? Reach out to me. You can find me on social media. Search Andrew Cady, Cady. I will get you a copy of the slideshow. If you want one, find me. I would love to connect with you and get that over to you. But I appreciate everybody being here. If there's no other questions that come in, again, it shows dedication to your craft. So kudos to you for taking time out of your day. I know how crazy your industry is, my industry is. taking 30, 45 minutes out of your day in the middle of the day to do something like this shows tenacity on your part and shows that you're going to be one of the ones that not only survives another year of a tough housing market, but thrives in it. So kudos to you. I appreciate your time and thank you all so much for being here.